The Nevada governor's office has gone dark on media calls about the Las Vegas condo market. Phone calls go unanswered. Press conferences get canceled. Behind closed doors, panic is setting in as one of the state's most critical revenue streams faces total collapse. Over 2,300 condos now sit empty across the valley, marking a 60% surge from last year alone. This isn't just another market correction. This is a financial earthquake that threatens to shatter the foundation of Nevada's economy. What started as whispers among real estate insiders has exploded into a full-scale crisis. Properties that once sold within days of listing are now rotting on the market for months. Owners who thought they struck gold are watching their investments evaporate in real time. The median condo price has already slipped below $370,000. But that figure masks a much darker reality unfolding across the Strip and beyond. The governor knows what's coming. Internal state documents reveal emergency meetings with economic advisors, desperate phone calls to casino executives, and frantic discussions about potential bailout scenarios. Nevada's budget depends heavily on tourism and real estate revenue. When the condo market crashes, it doesn't just hurt individual investors. It sends shockwaves through the entire state's financial structure. What makes this collapse particularly devastating is the speed at which it's accelerating. March inventory data showed over 2,200 units available, representing nearly 4 months of supply. By any measure, that signals a market in freefall. Normal markets maintain roughly 1 to 2 months of inventory. 4 months means buyers have vanished, sellers are desperate, and panic is spreading like wildfire through investment circles. The patterns emerging now mirror exactly what happened during the last major crash. Condos have always been the canary in the coal mine for Las Vegas real estate. When the broader economy shows stress, condos feel it first and feel it hardest. During the previous downturn, condo values plummeted 70%. Entire buildings went into foreclosure. Owners simply walked away rather than continue bleeding money. History is repeating itself with terrifying precision. Homeowners association fees are absolutely crushing current condo owners. Properties at premium locations like Trump Tower and Palms Place are hemorrhaging between $800 and $1,600 monthly, just in association costs. That translates to over $19,000 annually before mortgage payments, property taxes, or maintenance expenses. These fees have jumped 20 to 30% in just the past 2 years, creating an unsustainable burden for most owners. Special assessments are landing like financial bombs on unsuspecting residents. Buildings constructed during the previous boom are falling apart faster than anyone anticipated. Elevator repairs at some towers are costing $5,000 per unit. Roof replacements can hit $8,000 or more per owner. These bills arrive without warning, without votes, and without mercy. Pay up immediately or face liens that can lead directly to foreclosure proceedings. Nevada's Homeowners Association foreclosure laws create a nightmare scenario for condo owners. Associations can actually foreclose on properties for missing just a few months of fees. Their liens take priority over mortgage payments, meaning owners current on their primary loan can still lose everything over missed association dues. This legal framework creates a perfect storm where financially stressed owners face losing their properties even when making mortgage payments on time. Foreclosure notices are already spiking across the valley. Default filings have surged 28% year over year, and this represents just the beginning of what experts predict will be a massive wave of forced sales. The psychological impact of seeing neighbors lose their homes creates additional downward pressure on values as remaining owners rush to sell before their own situations become untenable. High-rise properties along the Strip are experiencing the most dramatic collapse. September sales data showed only 39 condos sold across all major tower buildings combined. Meanwhile, 494 units remained actively listed in those same structures. At current sales velocity, clearing existing inventory would require over a year, assuming no additional listings. But new listings keep appearing as owners recognize the market's direction and attempt to escape before losses become catastrophic. Individual buildings tell stories of complete market breakdown. The Signature at MGM, once considered a premium rental investment, sees units languishing for months without offers. Trump Tower properties are receiving price cuts of $50,000 to $100,000 and still attracting zero buyer interest. Even Palms Place, which permits short-term rentals that should provide income flexibility, managed only 4 sales in July. The luxury positioning that once commanded premium prices now represents a liability in a market where buyers have completely disappeared. The rental market collapse is destroying the business model that attracted most condo investors. Valley-wide vacancy rates have nearly doubled to 10% since 2022. Investors who purchased units specifically for Airbnb rental income, traveling nurse housing, or convention visitor accommodations are sitting on empty properties that drain cash monthly. Tourism numbers show consistent year-over-year declines. Convention bookings are failing to fill hotels at previous levels. The demand drivers that supported rental income have evaporated. Average rental rates for condos have declined for 6 consecutive months. Properties near the Strip face vacancy rates approaching 8% as owners compete against 12,000 new apartment units that entered the market over the past 2 years. Desperate landlords offer 2 months free rent, pay broker commissions, and provide other incentives just to attract tenants. The oversupply situation has created a race to the bottom that eliminates any hope of positive cash flow for most investors. New construction has frozen completely as developers recognize the market's dire condition. After this year, the development pipeline sits essentially empty. No major condo projects are planned. No groundbreaking ceremonies are scheduled. When builders who survived every previous downtown, except the last major crash, pull back this aggressively, it signals something fundamentally different is happening. These developers understand Las Vegas cycles better than anyone, and their retreat confirms the severity of current conditions. The luxury market breakdown reveals the true extent of this financial catastrophe. Over 100 condos currently carry price tags above $1 million, yet only 10 luxury units sold last month. 10 sales out of 100 available properties represents a complete buyer strike at the high end. Price reductions of $300,000, $400,000, even $500,000 on penthouse listings fail to generate meaningful interest. The Waldorf Astoria, positioned as the pinnacle of Vegas luxury living, sees units originally listed at $3.5 million, struggling to move at $3.2 million. What lurks beneath these headline numbers terrifies state officials even more. Conversion disasters are erupting across properties that transformed from apartments to condos during the previous boom cycle. Buildings like the Martin and Ogden are hammering residents with crushing repair bills as infrastructure fails simultaneously. Plumbing systems collapse, heating and cooling units break down, structural problems emerge that require immediate expensive fixes. Special assessments pile up so rapidly that some owners simply abandon their properties rather than continue funding endless repairs. The psychological shift in buyer behavior has completely upended market dynamics. 2 years ago, properties received multiple offers above asking price within hours of listing. Buyers waived inspections, made cash offers sight unseen, and competed desperately for any available unit. Today, sellers slash prices every 2 weeks and receive zero interest. Open houses sit empty. Real estate agents make increasingly desperate calls, begging for any offer, regardless of terms. The fear consuming current owners has become palpable and infectious. California exodus buyers who fueled the previous surge have completely vanished. Tech workers and remote employees who flooded Vegas in 2020 and 2021 face their own financial pressures. Stock options sit underwater. Home values in their origin markets are declining. They lack both motivation and resources to continue purchasing Vegas properties. Without this crucial buyer demographic, the condo market has lost its primary demand driver and pricing support mechanism. Investor sentiment has flipped from euphoric to panicked virtually overnight. Multi-unit buyers who assembled rental portfolios expecting passive income streams now carry 4, 5, or 6 properties bleeding over $1,000 monthly each. Short-term rental regulations have eliminated much of the Airbnb opportunity they counted on. Long-term rental markets are oversupplied and declining. They cannot sell without accepting devastating losses. They cannot rent profitably. They remain trapped in a financial nightmare that worsens monthly. Smart institutional money is already executing quiet exit strategies. Blackstone, Colony Capital, and other major players who accumulated hundreds of units during the buying frenzy are systematically reducing their Vegas exposure. They avoid publicizing these sales to prevent additional market panic, but public records reveal their steady divestment. These sophisticated investors employ teams of analysts and economists who recognize early warning signals. Their coordinated retreat confirms what individual owners are beginning to understand. The timeline for complete market capitulation appears to be accelerating beyond historical precedents. Previous crashes required 12 to 18 months for full price discovery and market clearing. Social media amplification, real-time data access, and instant communication networks are compressing this cycle dramatically. Fear spreads faster. Information travels immediately. Panic selling could trigger within 6 months or less once the psychological tipping point arrives. Economic fundamentals supporting the broader Las Vegas market are simultaneously weakening. Convention bookings continue declining. Gaming revenues have flattened. Tourism numbers show persistent year-over-year drops. Casino employment, traditionally a stabilizing force for the local economy, faces pressure as operators adjust to reduced visitor volumes. When Las Vegas catches an economic cold, the condo market typically develops pneumonia. Current symptoms suggest a much more severe illness is approaching. State revenue projections built on real estate transaction taxes and tourism-related income are crumbling in real time. Property transfer fees that helped balance Nevada's budget are evaporating as sales volume collapses. Hotel occupancy taxes decline as visitor numbers drop. Gaming tax collections stagnate as spending patterns shift. The governor faces a fiscal crisis that extends far beyond individual property owners into fundamental questions about state government operations. Behind closed doors, emergency planning sessions focus on potential intervention strategies. Bailout discussions explore options for preventing wholesale market collapse. Economic advisors debate whether state resources should support struggling homeowners associations or focus on broader tourism promotion. Casino executives receive urgent calls about maintaining employment levels and operational stability. The desperation driving these conversations reflects recognition that normal market forces have completely broken down. Current condo owners face impossible mathematical realities. Monthly carrying costs exceed rental income by substantial margins. Property values continue declining while repair assessments mount. Association fees consume increasing portions of household budgets. Selling requires accepting losses that many cannot financially absorb. The trap has closed around thousands of investors who believed that they were building wealth, but instead face potential financial ruin. Financial ruin. The evidence is undeniable, and the timeline is accelerating beyond anyone's worst projections. Nevada's governor can cancel press conferences and dodge media calls, but the numbers don't lie. 2,300 empty condos, 60% inventory surge, 28% spike in foreclosures, and a complete buyer exodus paint a picture of financial devastation that no amount of political spin can disguise. This isn't just another market correction that will bounce back in a few quarters. The fundamental drivers that supported Las Vegas condo values have permanently shifted. California buyers are gone. Tourism is declining. Rental income models have collapsed. Association fees are crushing owners, while special assessments deliver knockout punches. The same dynamics that triggered 70% value destruction in the last crash are not only present, but amplified. For current owners trapped in this nightmare, the math is brutal and getting worse daily. For potential buyers watching from the sidelines, remember that falling knives cut deep. And for Governor Lombardo and his administration, the silence speaks volumes about just how terrified they are of what comes next. The Las Vegas condo market isn't just struggling, it's in complete freefall, and the landing is going to be devastating for everyone involved.